2015 was an eventful year, even if it left investors in mainstream stocks or bonds, or mainstream stock and bond funds, little better off at the end than they were at the start. But what's done is done, and the secret now for investors is to see what lessons can be taken from last year so we can all better protect and grow our portfolios in the year ahead. Hello, I'm Russ Mould, Youinvest Investment Director, and in this latest edition of our regular markets review, Breaking the Mould, I'm going to look at the 5 trends that caused the biggest fuss in 2015 and look at what we can learn from them so we're better prepared for 2016 and beyond. Okay, so trend number 1 last year was that income was as important as ever, but finding it wasn't easy. 8 FTSE 100 firms cut or talked about cutting their dividend in 2015. 7 of those provided crunching share price falls to add to the insult of shareholder payout injury, as this chart behind me shows. This goes to show there are few worse investments than an income stock that cuts its dividend. So the lesson to be aware of here is don't overreach for yield in 2016. As we discussed in our last video before Christmas, do check out dividend cover, and if a yield looks too good to be true, it may well prove to be so. Trend number 2 to note is that Hungary, Denmark and Ireland were the top 3 performing developed or emerging stock markets in 2015. Well done if you spotted those, you've clearly got a crystal ball. Hungary went from zero to hero, helped by some unorthodox economic reforms from Prime Minister Viktor Orban, while Denmark was helped by the performance of drug giant Novo Nordisk, to remind us all of the importance of checking out an index's weightings and constituents, especially if you're buying a tracker or an exchange-traded fund. Trend number 3, well, that was the commodity price collapse, which showed that deflation was more of a threat than ever. China looks to be exporting deflation to the world as it lets its currency slide, and no one can ignore events in Beijing whether they want to or not. Mining and oil firms are adapting to this new reality of lower prices with cost and capex cuts, but some dividends look safer than others, especially as the Bloomberg Commodity Index stands at 16-year lows. Trend number 4 in 2015, well, that was the importance of foreign exchange movements. Central banks were still centre stage and engaged in a race to debase, as some of them relied on currency weakness to stimulate economic growth. Nobody wanted a strong currency, even if America and Switzerland each got stuck with one, while UK-based investors in European markets lost some of their capital gains on rising stock prices to weakness in the euro, the single currency. The lesson here is overseas investors may fight shy of UK assets in 2016 if a Brexit referendum looks like it will result in the UK's withdrawal from the Eurozone, while a strong dollar could be another theme for the second year running. If the Fed keeps raising rates, further strength in the buck is possible, and that, by the way, has historically been a bad sign for emerging markets. The 5th and final trend that ran through last year like a stick of Blackpool rock was the marked absence of volatility. Markets were generally mollycoddled yet again by zero interest rates and cheap money from quantitative easing programs, particularly in Japan and Europe, but that did begin to change, especially at the end of the year when the US Federal Reserve pushed through its first rate hike in nearly a decade. Even if that didn't really cause too much of a flicker, and only the summer showed any real volatility in equities, as shown by this chart of America's S&P 500 benchmark and the so-called fear index, the VIX, there is the chance there's more volatility coming around the corner because emerging market assets, commodities and junk bonds did see wild price swings. So the lesson here is to check whether this more extreme market action moves further in from the periphery toward the more mainstream core markets, especially if we get further divergence in monetary policy between central banks. What does this mean? Well, the 5th lesson is investors may need to ensure that they're running a well-diversified portfolio to provide downside protection as well as scope for gains in income. After all, we don't have that crystal ball. So thank you for watching, and I look forward to seeing you next time.